Jim Rickards, a renowned economist and investment banker, firmly believes that the impending recession will be the worst one yet. With a deeper market bottom than anyone has ever anticipated, everyone is on the verge of panic. The current market levels are significantly lower than it was last January 2022, and he even predicts that it could plummet further at around 30 to 50%. He adds that the Federal Reserve's plan to raise interest rates to counter inflation might cause an overshoot, which will lead to a severe recession. Hello and welcome to Eminent Investments. Today we'll talk about Jim Rickards' warning about a 40% crash that is bound to happen right after a severe recession. If you're astounded by his statement, then you might want to stick around and finish the whole video. Before we get into it, do give this video a thumbs up and subscribe to the channel. If you're done with that, then let's get right into it. Jim Rickards believes that there will be a crash that will fall around 30 to 50%, which goes to say that it's around 40%. Most people would use the S&P 500 as a means of measurement, and right now it sits at 4,000 points. However, Rickards believes that this will go down to 2,100 or 2,000 points. To gain a deeper understanding of the situation, Rickards stresses that you need to know the three sides of the story. First is the Fed story, second is the stock market story, and third is the bond market theory. However, Rickards adds a fourth one, the reality story, which tackles what's truly going on. The first story talks about the Fed's viewpoint on the market and the economy as a whole. The Fed's main goal is to counter inflation by aiming for a core PCE inflation rate of 2%. Core PCE inflation doesn't include food and energy prices, a decision that triggered criticism from economists. The Fed's way of obtaining its inflation target are viewed as resolute, even if it causes a recession or increased unemployment rates. The Fed's primary tool for managing inflation is by increasing interest rates. By doing this, consumer debt and spending may decrease, leading to increased demands for goods and consequently decreased inflation rates. However, here comes the challenge for the Fed. Finding the perfect balance with interest rates, they must use the optimal rate, called the target terminal rate, to decrease inflation rates without triggering other adverse effects. If they choose one that's too high, this might lead to an overshooting situation where inflation decreases, but as a consequence, the overall economy suffers. Conversely, by keeping the rates too low, the goal of reducing inflation will be far from attainable. According to Rickards, the Fed may tighten monetary policies without realizing that they have reached the prime level, leading them to overshoot and exceed the terminal rate. This in turn can cause a recession. So that's the Fed story. Let's proceed to the second story, which comes from the stock market. They believe that the economy situation is a Goldilocks story, where everything appears fine. If the stock market didn't have an optimistic outlook, there would have been a horrible crash by now. The Federal Reserve is hopeful that they will determine the perfect terminal rate, and they will soon halt the increased interest rates. They assume that when the recession finally takes place, they will begin lowering rates, which will provide the economy with a soft landing. However, Rickards stresses that the stock market's belief is nothing more than a fairy tale, and it's so detached from reality. This Goldilocks scenario highlights that the stock market is right and the Federal Reserve is wrong. Furthermore, Rickards claims that sooner or later, the Fed will realize the error of their ways, and they'll see the market accuracy, which will trigger them to raise interest rates. He adds that whenever a rate cut occurs, it's an indicator that people should start purchasing stocks. Wall Street even affirms that this is very common. Meanwhile, Rickards says that the bond market's outlook on the economy is more precise in anticipating future events. Each aspect of the global bond market points to one thing: an inversion, where long-term treasuries have smaller rates compared to short-term ones. This inversion can be observed in many different countries. This makes the bond market's message comprehensible and accurate. So what exactly is an inversion a signal of? Jim explains that this is a phenomenon where short-term rates are considered higher than their long-term counterparts. This inversion is a reliable and legitimate indicator of an impending recession. The recent inversion happened around 2007, a few months before the 2008 financial crisis took place. Today, the bond market is warning citizens that the crisis at hand can be a cause of concern, and it will most likely worsen. Unfortunately, based on the signals, the Federal Reserve can do nothing to avert the problem at this point. According to the bond market, which is directed to everyone around the globe, a recession is just around the corner. So that's the bond market story. Now let's move on to the real world story, which basically talks about what's happening to the rest of the world at the moment. In Rickards' point of view, the Fed will only keep increasing rates in their attempts to lower the effects of inflation, and this will happen whether we like it or not. He further explains that we are already at the terminal rate, which means it's not advisable to keep increasing rates. This goes to say that the Fed's plan to raise interest rates is incorrect, as this will only drive them to over-tighten, which will worsen the recession. With this, Rickards believes that impending recession won't be ordinary. In fact, it'll be a severe one. When the Fed finally realizes that the economy isn't doing so well, they might make rash moves for all the wrong reasons. If the Fed cuts rates, this is not because they're creating a soft landing for the economy. This is because they're messing up like they always do, which they've been doing since 1913. They tend to over-tighten, which Rickards believes is bound to happen. He stresses that we won't be experiencing a Goldilocks story with a happy ending. At the moment, the market has gone through a number of rallies since it last plummeted from its peak. In the early months of 2022, it decreased in June, but it rallied again in August. It went down again from August until December. This makes everyone wonder, are these rallies going to take us back to new highs, or are they short-lived blips as the market collapses? Rickards believes that the latter is more possible and that the rally is most likely to happen in January. The recession is only going to get worse than anyone has ever expected, and the bottom is going to be lower than what most analysts would expect. What we're looking at could plummet at around 30%, and we wouldn't be shocked if it goes lower at 50%. According to Rickards, we're looking at S&P 2000 or 2100. So here comes the big question. What are we supposed to do about this? What can we do to prepare ourselves? A lot of investors will tell you many different things. Michael Burry would most likely short the market. Warren Buffett would buy stocks, which he often does. He also holds large portions of cash. However, Rickards looks forward to selling stocks and looking into assets that do well during recessions. Rickards highlights that you should do this as soon as possible and that you shouldn't wait until the Fed figures this out. He further expects that around May or June, everyone will be preparing for the upcoming recession. His point focuses on the idea that the predictive analytic inputs would direct to that conclusion at the present time, and it would have done the same thing back in the fall. Rickards further stresses that we should prepare now because when the recession finally hits, it'll be too late to sell. Rickards also recommends diversification, but he doesn't mean this in stocks, but through asset classes. He prefers asset classes that are relevant despite whatever the market is going through. For example, the energy sector, which will always be needed whether the market is struggling or not. Natural resources like animal products, oil, minerals, wood, and more are also some of the assets that Rickards believes are relevant no matter what the condition the market is in. One notable investor who believes in the diversification of asset classes is Bill Gates, who is heavy on the agricultural sector. Rickards is not really against stocks, but he says that one must be selective in choosing the right stocks in relevant sectors. He gives a few examples such as ExxonMobil, Craggle, ADM, Marathon, and more. Other than stocks, he also highlights the importance of holding significant portions of cash, most preferably taking up to 30% of your overall portfolio. Bonds and treasury notes are some reliable options, including 2-year, 5-year, and 10-year notes. Furthermore, he adds that when the severe recession finally happens, the Fed will be forced to cut rates, which would make the price of notes too expensive. With this in mind, buying those notes now would be a good investment. Well, that's about it for today's video. Hopefully your newfound information will help you prepare for the upcoming recession. If you'd like, do give us a like and subscribe to our channel. Once again, this is Eminent Investment. Thanks for watching and we'll see you on the next one.